Let's talk about it specifically for fixed income and bonds with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, back with us here on the TD Ameritrade Network. Kathy, good to have you here. Let's talk the numbers this morning. It's pretty quiet right now. Is that what you would expect from what we saw in the data?
Well, the jobless claims figures were worse than expected, so you might expect a little bit more reaction to that. But it is the Wednesday before Thanksgiving holiday, so I'm not terribly surprised that it's a fairly quiet day. Other than the jobless claims, the durable goods orders were on the positive side. This is a pattern we've seen for quite some time, where the factory sector is doing well because it's open, and things are moving along on that side of the economy, but the service sector is a drag, and that's dragging down the employment situation, along, of course, with the coronavirus cases rising, and that's putting more pressure on the service sector, where people simply aren't willing to gather or able to gather because of restrictions.
Kathy, what right now is a better indicator, do you think, of how the data is fitting into this story of recovery? Is it the bond market or is it the dollar? Because we've seen some pretty sharp moves in the dollar, almost more clear than bonds over the last couple of weeks. When Pfizer reported the vaccine news, it was the dollar that snapped higher. When our PMI was real strong on Monday, same story. The dollar found buyers, where now it seems economic recovery that is kind of more organic is showing up in the dollar, whereas bonds have just been kind of trending higher in yield for about 3 months now. What do you look for in terms of kind of that clarity? Should we expect bonds to be a clear indicator of what's happening in the economy?
Probably a lot less so than the dollar. So we've been pretty adamant that the foreign exchange market is where we'd see the big reaction to any changes in the economic outlook. And I think that's consistent with what we're seeing. You know, the big picture story is the dollar's going down on the global reflation trade. So as long as the idea is that we're going to have this easy policy, we're going to, second half of next year, things are going to get better, the dollar's likely to continue to go down over the long run. We're going to have some bounces because it gets really oversold in the short term. But that's really the story, I think, that's being told. Not so much in the bond market, because you do have the presence of the Federal Reserve buying $80 billion a month in treasuries, talking about maybe extending those maturities. We'll see later today when the FOMC minutes come out. Maybe they'll actually buy more long-term bonds to hold down those yields. So the bond market is kind of caught here for the near term, I think, on the Fed policy, while the dollar is more free to reflect what's going on in the global economy.
So, Kathy, when we look at how the dollar is sitting at these lows of the range the last several months, and then we look at the bond market where yields have been slowly inching higher, what then role does the policy side of this play? Should we expect any surprise stimulus talk to be dollar negative? And then yields, that's the part where I'm not sure, right? It seems like the dollar's told us, hey, if there's stimulus news, it goes lower. In terms of bonds, I don't really know at this point, right? Do we view it as stimulus as being an economic jumpstart or accelerant and yields go higher? Or does the bond market look at stimulus and money and printing happening from the Fed and say, all right, actually yields are going to stay low, and we're going to, I have no idea at this point.
I think you have a time issue here. So in the FX market, stimulus is negative for the dollar because it helps the global economy. That means people will look to riskier assets like emerging markets and some of the other asset classes, commodities, those things, because that's going to be the global reflation trade that we've seen over the last couple of months. And if we have more fiscal stimulus, that's probably what we're going to see. The bond market, though, has the near-term negative of the fact that we've got rising coronavirus cases. We've got talk that the Fed may, even do even more to hold down rates going forward to get the economy back on its feet. I think in the second half of next year, assuming we get this vaccine, assuming things start to improve, that's when you'll start to see bond yields move up a bit. They're not going to go sky high, probably. And we're not looking at 5-6% on 10-year treasuries, but we could certainly see north of 1% in the 1 to 1.5% area in the second half of next year, assuming the economy's getting better because we have a vaccine to open up the sectors that have been hit pretty hard.
Kathy, right now there's the kind of secondary drama on the policy side. As we heard last week, the Treasury Secretary Mnuchin wants some of the CARES funds placed back. But then now we've got the announcement that President-elect Biden is going to choose Janet Yellen to run the Treasury. And it's kind of like the Treasury and the Fed are going to be almost synchronous as one, as they already have been kind of moving in that direction. What do these stories mean? I want to first get the thought on the CARES money. Did that story come and go already, or is there a potential meaningful impact of that?
You know, I think it's going to be an interesting story that has to play out, because there's a lot of question marks as to whether or not presumably Janet Yellen at the Treasury can claw back that money. There's perhaps the move that Mnuchin did was illegal. I don't know how that plays out. This seems to be a political play on the part of the Senate Republicans, who don't want to see the new administration have the freedom to use those funds as the previous administration did to parcel, say, to state and local governments. You know, they have their own agenda in terms of what they want to see done with those funds. I think it's going to be a bit of a tussle and a tug of war, but ultimately, I think you're right that the Fed and the Treasury are going to work closely together. They've been doing that really since the financial crisis. I think they'll continue to do that going forward, particularly as long as the economy is struggling with the coronavirus crisis. There's going to be more coordination, I think, between fiscal and monetary policy than there has been in the past, and that's appropriate given where we are. It's the national emergency that they need to address.
And Janet Yellen, what we know about her experience at the Fed, I was kind of surprised that we didn't get a more clear reaction from markets that was bond positive, NASDAQ positive. It seems like maybe we got a little bit of that yesterday, kind of a delayed effect. But do you think that Yellen's appointment should give us a clear kind of indication of what policy is going to look like in the Biden administration?
Well, I think what we're seeing in the markets is the expectation that it'll be a steady hand. She'll be a steady hand to Treasury who will actually continue the current policy. So the current policy, up until Mnuchin decided to take the money back, has been coordinating with the Fed, providing a lot of ample funds to the economy. And I think that continues at the Fed. So I think the lack of big reaction is maybe an indication that the markets don't see a huge change from where we are today. Longer term, we'll probably see emphasis change in terms of what the Treasury might choose to do. But I think for the next 6 to 12 months, we're just going to look at this policy coordination and effort to get the economy back on its feet as continuing pretty much as it has over the last year or so.